Good evening, sir.
Yo, this is episode 74 of the Beef and Bitcoin podcast with your hosts, Brett and CH. Today's topic, saw a really good presentation from VanEck called The Investment Case for Bitcoin. I had a chance to go through the slides, and I thought this would be a really good topic to talk about right now, especially since GBTC volume has been going up. The premium is around 30%, maybe even as high as 40 on some days. So looks like there's more demand from someone who I would consider a non-retail investor, maybe more of your institutional folks, maybe baby boomer, or maybe even high net worth individuals or family offices who are starting to take a closer look at this. And it's exciting, but anyway, this presentation is fantastic, and Gaber Gabox had posted this, and he works for VanEck, and VanEck is also one of the ones who proposed a Bitcoin ETF that we covered, last year sometime in an episode. That ETF ultimately did not go through, which isn't a surprise, but it was really good to see them put the time and effort into this presentation called The Investment Case for Bitcoin. And they broke it down into three basic sections, and I think that was a good move. So the first one is Bitcoin as a potential store of value, Bitcoin's role as an investment in an investment portfolio, and then last but not least, accelerating Bitcoin adoption. So why don't we get started on Bitcoin as a potential store of value? So, the first thing they did was break down the differences between intrinsic value and the monetary value. Now, I'm not too much a fan of using the term intrinsic value. I prefer to, go with the Austrian view of all value being subjective. So, I like to say more monetary premium and then cash flow generating assets. So when they talk about intrinsic value, they're talking about capital goods or economic goods that produce cash flow. So that could be real estate, that could be dividend yielding stocks. Whereas when you compare that to, say, Bitcoin, gold, diamonds, or other things, those do not produce any cash flows, right? And you can see that if you're watching this on YouTube, on the left-hand side, you're seeing goods with intrinsic value, and then goods on the right-hand side are just a monetary value. So just to be clear, that's how they kind of defined it. There's a big difference between assets that generate cash flow and assets that do not. And one of the things when I was reading this was, just the simple fact that gold, silver, diamonds, Bitcoin, and artwork, and even fiat money have value just kind of goes to prove the subjective theory of value, right? People like gold because it's a shiny yellow rock that's pretty rare, and that's just human intuition, right? People put value on that regardless.
Yeah, it's been in money for 5,000 years or over 5,000 years, and so has silver in the past. Silver lost I think, if I remember correctly, China was heavy into using silver as a currency into the late 1800s, and she got crushed because they were mainly on silver, and silver by the late 1800s was not obviously as valued as gold was, because gold became the international standard up until World War I in 1914, when all that collapsed and the beginning of fiat currency for most countries came along. But again, it's just one of those interesting things that silver, again, has been used throughout history. The Roman Empire, you had the denarius, which is the denarius, which was the silver coin, and the aurarius, which was the gold coin. And I've said this numerous times before, but with the collapse of the Roman Empire, they inflated the coins by, taking out the gold and silver content in the coins to the point where the denarius, since silver is not as hard as gold is, it rubbed off and you could see the copper below. And so,
I think you brought up a really good point. It's, we've seen this time and time again throughout history where the debasement of the currency has been the first crack in the overall destruction of that economy or civilization, right? And sometimes it can take a really long time. If you look at the fall of the Roman Empire, I mean, it took forever, right? And then now you can point and say, oh, they really shouldn't have debased the currency over time. And it's hard living it today. We know that our currencies being debased over time, whether it's the cost of steaks between 10 years ago, haircuts, going to the movies, whatever, that the money is becoming worth less because you have to spend more and more of it to either do the same activity or buy the same thing. And it, they did a good job. I think if you move on to the next slides, slide 5 and slide 6.
Monetary value.
Yeah, that just kind of go over the monetary value. And they just did a good job talking about gold. So they said monetary value usually arises from special needs or circumstances. So gold acquired this. I prefer monetary premium because I think it makes more sense because it's scarce, durable, relatively easy to make into coins, bars, etc. And then Bitcoin has this monetary premium because it's relatively scarce in the digital world, and that's a little abstract for some people to wrap their minds around. Has strong privacy characteristics, and it's a bearer asset or instrument that can be sent from point A to point B, but with its digital nature, it can also be memorized, which is, if you're memorizing your recovery seed and things like that. So the one thing that I think is important to note that's different between gold and Bitcoin is that Bitcoin's monetary premium is 100%. In other words, its only use is being money, which is very different from gold, where the monetary premium for gold is still quite high. I'd probably put it far above 80%, maybe even 90, 95%, but there's still that other use case that gold has as a commodity, right? It's used for jewelry, for ornamental purposes. It's used in electronics and engineering. It is ultimately a metal. So that's where it's very interesting to compare the two things to be used as money, where one is very useful for its chemical and physical properties and also is useful as money. And then the other one, it's only useful as money. It's not useful as anything else. So I think that's kind of interesting to think about when you think about how things have a monetary premium attached to them.
I was going to say the artwork example is a pretty good example. Like, until the last, probably 400, 300 years maybe a little even less than that, artwork, as a value. When you look at these like paintings like the Mona Lisa, where you look at all those movies and real life examples of, heist and thieves stealing artwork that's worth millions and millions of dollars, and it's just a painting. But people attach a price. Like in December 2019 here, someone pinned a banana to a wall and it was worth it sold for $120,000. And after the banana was eaten, the people still said it had value because it was, I don't know why. But I mean, if that doesn't show you where fiat money is taking us now, in the current day, that a banana being pinned to a wall is 120 grand, which is like 4 times what the median worker makes in America, I don't know what does.
Yeah, we've gotten really far away from sound money in this case, and it's amazing to see. Why don't we keep going can we go to slide 6 and 7? One of the next slides
Only
shows,
if you say please.
Please. Yeah, we can. All right, we can skip this one. I want to go to the next slide. This one's pretty good because it's comparing, if you're watching this on YouTube, the slide showing a comparison of gold, US dollars, and Bitcoin, and then the various traits of money. I don't want to go through all these because there's just way too many to go through, but the ones that I really wanted to focus on were portability, divisibility, security, and decentralization. So when we talk about portability, if we compare gold, dollars, and Bitcoin, gold is moderate, right? It's small enough that you can transact with it personally, peer-to-peer, right? You can go and hand someone a gold coin for goods and services. That's fantastic. US dollars, a little bit more portable, lighter than gold, not as dense, right? There's to move $1,000 or a couple $1,000, you'd need a ton of hundreds, and and then Bitcoin, it would be even more portable, right? You can send almost any amount of value that you want, and with the click of a button, highly portable. Don't need to be in person to do so. So that's an interesting comparison between them. The divisibility, I think, is another one that's very interesting to compare. And, you and I always talk about gold and silver being used as money. And, one of the reasons that silver was useful as money was because gold was just too damn expensive. It would be really difficult to shave off a couple of grams of gold to pay for a low value item, right? And that's where silver comes into play. It's not worth as much, it's not as dense, right? So you can have a gold or a silver coin, and that could pay for smaller value items or goods and services, whereas you can't pay for a book with an ounce of gold or a gold coin because the book isn't worth nearly as much as the gold coin.
Speaking of gold, I was going to say gold's up 1.4%. It just opened up on the week. It's Sunday right now. We're recording, so I just wanted to mention that. Pretty big deal, I guess.
Yeah, it is a big deal. Gold's been moving a lot recently. We've been talking about it a lot. So it's important to look and compare these harder assets, especially in a time like this.
And I was going to say earlier, but you were talking, Bitcoin did cross 10K briefly, and it dropped back, but it was testing 10K, briefly crossed it earlier.
I guess we'll see what the rest of Sunday has.
The weekly closes in 39 minutes.
Yeah, here we go. And then getting back to the divisibility aspect, dollars are also fairly divisible. I'd say more divisible than gold, but they're both ranked as moderate here in this example, which I think is fine.
That's fair.
Yeah, I think that's pretty fair. You have different denominations of paper money, also coinage. It does get the job done. And then from a divisibility standpoint for Bitcoin, it's ranked higher than moderate just because, each Bitcoin is broken down into the Satoshi level. So, you can pay, and especially if you're talking about other solutions like Lightning Network, where you can send a few pennies around the internet, that's pretty cool. It's just the nature of something being purely digital. It has different trade-offs and characteristics than dollars or gold. So that I thought that was interesting that they covered. Go ahead.
I was going to say to tack on to the highly divisible part. I think if you look at the history of the U.S. dollar, and obviously if you include change, like nickels, dimes, quarters, etc., half dollars, things that definitely, obviously, even in my lifetime, drastically went up in price due to inflation. And if you go back like 40 or 50 years, there was a point to having change. Things cost. There was a lot of objects or items, whether it was a candy bar, whether it was a gum, whether it was a Coke, whether it was a water, would cost less than $1. So it made sense to have a quarter on you or have nickels and dimes. And now change is pretty relatively worthless for the most part, in my opinion.
No, I think that's very well put. All right. The inflationary nature of fiat monies has made, pennies, nickels, and dimes pretty much useless, whereas you could carry around a handful of change with you, and it was useful to either buy a stick of gum or water or whatever. So very good point there. The next one to touch on was security, and basically cannot be counterfeited. Gold and dollars are marked as moderate, and Bitcoin's ranked as high. And we've seen counterfeit gold, we've seen counterfeit dollars. Bitcoin's just different in this example because it's really difficult to counterfeit exactly. Now you could say, well, there's a ton of forks, and I would consider those counterfeit Bitcoin and more scams. So there is that, but at the same time, that's the whole point of being able to self-validate these kinds of transactions, that you don't have to necessarily be concerned about counterfeit Bitcoin. When you accept it, it's validating that for yourself. Whereas, I don't know, if someone was going to buy your car off of you and they'll be like, yeah, man, I'll pay you in, a couple bricks of gold, you might think twice about hiring a professional to authenticate its or validate its authenticity. I don't know if you had anything to mention on that.
I was just going to say the secure side, I definitely get that, but I also would say with Bitcoin, again, the getting hacked and other stuff, I don't know. I guess they cannot be counterfeited. It's a good part, but definitely when we think about Bitcoin's like, and we're going to get to this eventually, the institutional side, the hardest thing holding institutions back is the custody side. And I know we probably might touch on this, but like that's what makes the things like the Grayscale investment, Bitcoin Investment Trust, GBTC is the ticker, phenomenal, because it's like for a lot of people who aren't tech savvy or you want to have exposure to Bitcoin, the scary side of Bitcoin is if something gets hacked, if you send it to the wrong address, etc., which like you and me are comfortable with, but like people who are older than us obviously aren't. It's a whole different realm. And that's what makes things like GBTC great, and obviously what VanEck was trying to do with their ETF.
No, yeah, I think that's a really good point. That is definitely one of the trade-offs of when you're dealing with something that's purely digital, right? So that's a really good point. The last thing I wanted to mention was the decentralized aspect of comparing the three different ones. I think this one is easy to overlook when I think about in terms of a high net worth investor or an institutional investor. I'm not so sure that the decentralized nature of the different monies clicks for them as it would for maybe, say, you and I, who've done a little bit more studying on monetary history and how different monies have been co-opted over time. So, with gold, it's interesting because you would think it would be relatively decentralized since it's non-sovereign, right? It's not issued by anyone. You can dig it out of the ground and use it for other things and hide it and things like that. But just as we saw with Bretton Woods and gold being confiscated under Executive Order 6102, it is more susceptible to seizure in this example and can ultimately become centralized, and then you're issuing more credit than the amount of gold you're holding in reserves, and that's where we get this extended fractional reserve nature of gold as money, which it's an interesting argument, and gold kind of has to be scaled up in a way, and that's where kind of paper money comes in, using gold as a reserve asset. And then, paper money is like your layer 2 solution where you can trade IOUs back and forth. That's how you scale something like gold, and it's just fine. People just need to understand the different trade-offs of that. Whereas you compare that with Bitcoin, where it's more decentralized, there is no central issuer, and it is more expensive to seize it and centralize it than, say, something physical. And again, that just has to do with its digital properties in nature. Why don't we move on to the Bitcoin's role in an investment portfolio? I want to say that's one of the next slides or two.
Institutional exposure or next one?
Yeah, let's keep going. Let's keep going. Okay, Bitcoin's role in an investment portfolio. They go on to discuss how Bitcoin fits into a modern investment portfolio. Previously, one of the things that they start with, obviously, is Bitcoin stock to flow model, right? So they talk about Plan B right up front, and that's right on the next slide if you want to move to that. And just to go over for those that don't know, the stock to flow ratio is defined as the amount of an asset that's held in reserves divided by the amount of the asset that's produced for a selected time period. So let's say a year. So when you're looking at the stock to flow ratio of gold, basically, it's all generally understood that the supply of gold increases by 2% annually, right? That's the 2% inflation rate for gold. So that means that would give gold a stock to flow ratio of around 50 or so. In other words, hopefully to explain this a little bit better, it means that it would take about 50 years to double the supply of gold, since the majority of the gold has already been mined out of the ground and we've been using it for thousands of years. So that makes sense. It's difficult to all of a sudden inflate the supply of gold, which is very different from fiat money, as you and I have talked about with all the repo operations and bailouts and all this stuff. It's pretty easy to just increase the supply of fiat money. But the stock to flow model is interesting, and this is where I start to I have a question for you here with regards to institutional investors or high net worth individuals. I can look at the stock to flow model. I've read Plan B's articles. I can see if you're watching this on YouTube, you can see the graph on the left hand side. It's very highly correlated, like a 95% R square. Gold's right up there, being line almost through it, worth about $10 trillion in market cap relative to its stock to flow. Then it has silver coming in there with the grayish dot, and that makes sense with its overall value. And then you have Bitcoin over time. Then on the right hand side, you can see how the model predicts Bitcoin's price based on its stock to flow model. Now, of course, I do daydream about the stock to flow model being correct, because it fits my narrative, my overly bullish narrative of Bitcoin's price going up. But the biggest criticism of the of the model is that demand isn't really a part of that model. So, now it's been months now. We've seen Raul Paul talk about stock to flow model. We've heard Dan Tapiero talk about stock to flow. We've even heard, your anchors on CNBC talking about stock to flow model.
Our boy Joe.
Yep, our boy Joe. So what do you think? Do you think institutional investors or high net worth individuals will be able to relate to the stock to flow model, or they'll just completely dismiss it?
Obviously I talk to people about people ask me what I do, whatever, and crypto and Bitcoin obviously comes up, and there's definitely in the past year and a half, 2 years. Obviously, when prices were going retarded, people all wanted in. But then I think in 2018, after the price depression, you saw a lot less disinterest. But in the past year, the guy I went to use sauna last night, and there was a guy, and we were speaking about markets and stuff, and I told him, about Bitcoin and crypto, and he was, interested, and he was just wondering about it, and you could see he was definitely interested in it, and he's in real estate more, and in the stock market, of course, but and he was probably 55, something like that. But there's definitely an interest there in Bitcoin. And I was telling him, if you want exposure and don't want to deal with the custody, I told him you should look into GBTC. I told him all about how the premium though right now, I think it's $10.50 a share. I can check really quickly. I'm pretty sure it's something like that.
I think it was at $12.50.
Oh, you might be right. Yeah, $12.50. So the premium's a little higher right now, but as we talked about before, it ran to $39 a share when Bitcoin hit 20K, and I told him, I was the premium's higher right now than you'd be paying for a physical Bitcoin, but you don't have to worry about the custody side. And I told him the swings to the upside very much favor for you, and even when at its lowest point, its premium, you didn't get crushed. When it went to its lowest point, it didn't drop below $3 and 75 cents when Bitcoin hit 3,200. So you're not getting screwed on the downside, but the upside you have a chance to be double of what, at least looking at the history of GBTC, double of what Bitcoin was at the peak. So, some food for thought.
Yeah, it's important to mention GBTC to those types of investors who really just don't want to deal with the hassle of a digitally native asset. It just might not make sense for a lot of them, which is totally fine. And I think that's a good option.
And at the end of the day, GBTC has to buy physical Bitcoin, so that's good.
Right, exactly. Driving that demand increases the premium, and then Barry Silbert has to go and buy more Bitcoin the next day. It ends up ultimately working out. Yeah, this next slide is exactly what I wanted to go to. So they're talking about the halving supply shocks. They do a good job of explaining what the halving is. And for those that don't know, the halving is a 50% reduction in the block subsidy, and that happens about every 210,000 blocks, or approximately every 4 years. So as of today, every 10 minutes when a new block is mined to the chain, 12.5 Bitcoin get released to the miner that won the block and wrote it.
SPX, the S&P futures are down 1.1%.
Oh, there we go. Markets are getting ready to open here.
I'm just really quickly looking at this because I just remember they're all of them. NASDAQ is down 1.3%. Sorry, I have to say that because it's gonna be, as I said, this weekend, everything's changing. I'm sorry, keep going ahead. This is why owning hard assets, Bitcoin, gold, silver, etc., is important, because what's going on right now with the coronavirus, we're seeing, and I keep mentioning it, Italy. I've seen numerous pictures of supermarkets in Italy completely empty in Milan because of what's happening there. It's complete quarantine. So just be aware that can happen in the U.S. too if you live, or anywhere in the world. So just keep that in mind. But back to the halving price.
Yeah. So the chart shows it indicates the first halving in almost beginning of December 2012, and then the run up, and then the next halving in July of 2016, and then the subsequent run up into 2017. And I try to do a little quick math to try to explain this for those of you who are just listening to the podcast and not watching. So after the first halving in end of November 2012, the price increased 11,000% to the top of the 2013 bubble. And then the next halving was summer 2016, and that was followed by a 3,500% increase. So I don't know, if you're the reader and you're looking to this, you might be able to say, oh, okay, halving happens and then number go up afterwards. All right, great. There's not too much to know there. But do you think that the new money that's coming in will have any idea about what the halving is or how its economics might impact the price of Bitcoin? And, I want to caveat that with saying when I was getting into the space in 2017, I had no idea that the halving had just happened the summer of 2016 and that, these run-ups can happen after the supply shock. So I had no idea what I was buying, that I was buying into the kind of the bull run of 2017.
Yeah,
so
I was gonna say, when I got in, I was researching everything about Bitcoin, and I read the white paper. I was reading everything about, like, IBM had a bunch of these videos and like notes on blockchain and what, and obviously most of it dealt with Bitcoin because Bitcoin's the original blockchain. I'm dealing with that, so I don't think I really understood the I guess the halving as much probably until maybe later in 2017, I would say August 2017, something like that, and it might have obviously popped up along the way, but new money for sure. Like, I know the amount of people that DM me about crypto whenever prices go up, when number go up, a lot of them have no clue. They have no clue. If you told them, what's the halving? And they'd be like, what? No, a lot of people have no clue. And exactly here, when Bitcoin, the halving price was $657 on July 9th, 2016. And, 18 months later, 17 months later, it was 20K.
Right. Yeah, it can just move so fast. I'm really glad that they put in the halving into this presentation, because although the event of the halving itself can't increase the price on its own, right? But it's important that people understand the underlying economics of the supply that's available for sale, that's being produced on a daily basis, is decreasing. And if demand is typically staying the same, what does that mean for the price, right? If you think logically, you say, okay, well, I suppose that the price would go up, but it's certainly not predictive. But it is good to have an understanding of just the basic supply and demand function, and that the one thing that they missed on here, unless I didn't read it, was that the supply just can't be increased willy-nilly. So if the price of Bitcoin goes up, you just can't make more of it. And that's different from other commodities, something like silver or copper. If the price of copper doubles overnight, you can bet your ass that, copper production will go through the roof tomorrow. Yeah. And then, it brings the price back down to equilibrium and so on and so forth. So, Bitcoin's, again, its digital nature allows it to just have different properties that physical commodities don't have. All right, I want to move on to one of the next slides, because I think this one's interesting, because it starts to talk about Bitcoin as how it plays a role.
This one?
This one's good. I think I wanted to move more towards the next slide, because it's showing Bitcoin in a traditional
correlation
allocation to a portfolio. Yeah, one more slide, actually.
This one?
Yeah, this one. This is the one. Okay, so this slide. I didn't mention this at the beginning. We probably should. That obviously none of this is investment advice, but it's always to be taken with a grain of salt and to kind of do your own research with this kind of stuff.
So here's what you should do. You should buy a VPN, make a BitMEX account, and 100x long Bitcoin. I promise nothing will go wrong. No, of course, none of this is investment advice. I'm a retard. So there you go.
All right, that's the disclaimer. But this was probably one of my favorite slides to look at when I was going through this presentation, because this is more real life. For the person who's consuming this content, they have portfolios that look like this. And for the people who are just listening and not watching on YouTube, it's showing how, if you insert a non-correlated asset like Bitcoin into a portfolio, what can it do for you? Like, what are the benefits? So basically, the conclusion that if you look at this is you can have a small percentage of your portfolio allocated to Bitcoin, and all of a sudden you're increasing the Sharpe ratio of your portfolio, which in a layman's term to kind of describe that is you're getting more bang for your buck, and your risk-adjusted return is you can risk a couple percentage points, and it's not the end of the world if it goes to zero, but you could have outsized returns otherwise. And this slide really goes towards, Pomp's argument of get off zero, right? So even a small percentage can move the needle and make a big difference. So I wanted to run through a couple of these portfolios to kind of explain it. So the chart goes from January 2012 to December 2019. And if you were holding 100% of your portfolio in the S&P 500, you'd have an annualized return of 14.5%, which is pretty good, right? That's very impressive for the S&P 500. But your allocation is 100% exposed to that. And then Bloomberg Barclays US Ag was annualized return of 2.8% over this 8-year period. And then you start getting into your more structured portfolios. So a 60% equity portfolio versus 40% bonds returned 9.8%. So there's your almost 10% annualized yield. Not bad. And then this is where it starts to get more interesting, where they throw Bitcoin into the mix. So a 59.75% equities, 39.75% bonds, and then a 0.5 percentage point exposure to BTC increases that annualized rate of return by 1 percentage point to 10.72%. Now, as you increase that percentage 2 more times that they're showing in the graph here, you have a 1% exposure to Bitcoin added to, 60-40 split equities and bonds gives you 11.61% annualized return. That's pretty good. And then the last one is a 3% exposure to Bitcoin with, call it 58% equities and 38% bonds. That yields annualized return of 15.13%, which beats out the S&P 500 on an annualized basis over the last 8 years. So when you think about this, that adding a little bit of exposure to Bitcoin all of a sudden starts to give you more outsized returns. And I would argue it is less risky than leaving 100% of your portfolio in the S&P 500. Do you think seeing this chart starts to move the needle for, your more institutional investors or high net worth individuals?
Yeah, and as I said earlier, I think as 2019 is going on, because obviously 2018 was rough for crypto, but 2019, with Bitcoin going back to 14K and now Bitcoin being at basically 10K, I think a lot more people are now kind of realizing, okay, it's staying around, it's not going anywhere. And I'm sure as the 2020 decade, goes forward, you're going to see more and more, ultra high net worth people and high net worth individuals looking to get, exposure to Bitcoin and I guess crypto, you could say too, just for the fact that it gives them another, instead of just being, as you said, it's a lot more risky to be 100% invested in the S&P than it would be to have, maybe 94% and 6% BCC or, however you want to put it. And this obviously did a pretty good breakdown of a typical portfolio. And it's unfortunate that if you're listening to this, you can't see the chart. It's nothing crazy, but you can see that obviously the best is having more exposure to Bitcoin. That doesn't mean go throw everything into Bitcoin, but, the returns on Bitcoin will generally be, at least, the earlier you are, obviously, far more than, a regular index. Now that changes if you're investing in individual stocks, and that changes the whole name of the game. But when you're just looking solely at investing in S&P, investing in bonds, then, having a little Bitcoin is not the worst thing in the world.
Yeah, and I think even Plan B has posted charts where a 95% cash position and a 5% Bitcoin position is pretty much, it beats the S&P 500, or is, if not, is very close to it. And you have to, when I sit and think about that, And, I think about my 401k that has exposure to the S&P 500 and all this other stuff. And you're like,
So little
wow,
risk.
yeah, there's just barely any risk keeping 95% of your assets in cash, or you call them dollars, treasuries,
Liquid.
whatever kind of equivalent, and then 5% in Bitcoin. And it can outperform or do just as good as what you'd pay a money manager to do for you. It just starts to get really, really interesting, because your average Joe who's not going to invest in the stock market, but I don't know how to put this, but is also maybe naive enough to buy Bitcoin, it ends up really working out for them in the long run, where you have, somebody who just doesn't know anything about investing, buys some Bitcoin out of just, I don't like to have used the word naive, but just as, I'm going to buy some Bitcoin on Cash App, whatever. Let's see what happens. And then they do very well. Are they a professional investor now because they're doing better than actively managed hedge funds all of a sudden? It's fascinating to really think about.
Yeah, no, it'll be interesting, again, like where is Bitcoin going to be in 10 years? And, the people who, went heavier into Bitcoin, or even the people who just had, say 5% exposure of their assets to Bitcoin succeed very well here.
Right. Well, speaking of that, I think this is a good time to get towards the last portion of their presentation, which is accelerating Bitcoin adoption. I think that's one or two more slides down. Not that one, one more. Not that one more. Okay, let's skip to the next slide. Yeah. So, the first thing they talk about here is that cryptocurrency exchanges are still growing. There's a lot of money to be made. We've seen new exchanges in the last 3 years. Binance really broke out and did very well. You've seen the CME futures launch. Backed launched. BitMEX is doing extremely well. Cash App launched. Robinhood has Bitcoin and other cryptocurrency trading. So, even though the overall market cap of the entire cryptocurrency space is still a drop in the bucket compared to these $1 trillion assets and companies, it does look like there's growth there. So I think that was a good slide for them to put in, just to kind of bring peace of mind that it's not like there's one exchange open that's selling Bitcoin. And actually, we're going to talk about that on the next slide, I believe. That shows the concentration. One more. That shows the concentration of Bitcoin trading across different exchanges. Now, there is one caveat for this who are not watching on YouTube. You'll notice that Binance and BitMEX are not on this chart. And I'm sure that has to do with regulatory reasons why they would choose not to put it on there. But I'd say Binance and BitMEX have
they're big.
That's where the volume is.
BitMEX obviously it's huge, and then Binance too, of course.
Right. So again, this to you and I, this chart doesn't mean anything to me. But maybe if I'm an institutional investor, that might have come across my mind as, if they shut down one exchange, is the whole thing done? And that doesn't really look to be the case here.
Coinbase is obviously way up there, and that's like the gateway for the noobs.
Right. Yeah. You have your Coinbase and Kraken are total of, around 40%. Then Bitstamp, which still surprises me, has 14.5%. Bitfinex 12%. Gemini's down there 2.5%. But I don't think the Winklevoss twins care all that much because they're sitting on the heaviest Bitcoin bags of anybody.
They're so rich too.
I know. Yeah.
It's not even
so. But, either way, good chart to look at. I'm glad that they decided to throw it in there. The next slide is actually pretty interesting, and it shows the I want to go one more slide. That one I don't care about.
Because it's the ownership?
Yeah, the ownership. You can flip back for a second.
I think it's pretty important to...
Yeah, so... Here's the caveat with this. So this slide, for those of you watching on YouTube or listening on the podcast, it's showing the ownership distribution by wallet or by Bitcoin address, and showing how it's, it's fairly well distributed. You got a, kind of a Pareto distribution here, which makes sense. You've got 3 wallets that own 2.7% of all the Bitcoin. So these wallets have above 100,000 Bitcoin, and there's only 3 of them. And then, of course, there's more wallets that have less Bitcoin in them. And probably one of the more interesting ones is there is 134,000 wallets or addresses that have between 10 and 100 Bitcoin. Now, the caveat, and they do mark this, is that wallets, there can be multiple wallets or addresses per person, and these figures also do include exchanges. And if you look at Coinbase, Binance, BitMEX, I mean,
I'm sure they're in the 10,000 to 100,000 area.
Exactly. So, those are, entities that have a significant Bitcoin holdings just because that's the nature of their business. But, it's really hard to say if how accurate these kinds of charts are, because if you're using Bitcoin properly, every time you're withdrawing Bitcoin from the exchange, you're withdrawing it into a new address. So if you have one Bitcoin in total and you're withdrawing in 0.1 increments, you'd fall off on this list somewhere. You drop down to the next bucket. So it's really hard to look at to just scan the blockchain and say, oh, these are the same person. You can't really do that. So it's something to keep in mind, but it is fairly well distributed compared to other cryptocurrencies that have airdrops and dev funding wallets, or escrow like Ripple and stuff like that, where they're just holding all the coin. I mean, it is clearly the most distributed amongst the plebs, if you had to say.
Distributed amongst the plebs. That's a good way to put it.
But
on to the next one.
Yeah. The next slide talks about nodes. So this one's another metric that is hard to verify, just because it's showing that there's 10,435 nodes in existence, but I don't think that includes nodes that are running over Tor or nodes that are private that are more difficult to identify. And that might just have to do with Lightning. I'm not 100% sure, but it looks like there's nodes out there. And considering how difficult it is for a non-technical person to kind of run a node, I'm surprised that there's 10,000 of them out there. It looks like 20% are in the United States, 17% in Germany, which I didn't expect, to be honest with you. France has 5%, Netherlands has 4.5%, Singapore has 3%. And if I'm an institutional investor, this slide is meaningless to me. If you're not at that technical level trying to think about what a full node is, it doesn't matter to me. Do you think this makes any difference to them?
No, I don't think so.
Yeah.
Looking at this, you can host
Yeah.
as little as 200 gigabytes.
So the next slide, I think, might have more interest to an institutional investor or someone who's wanting to take a closer look and trying to figure out the demand for Bitcoin. And this chart showing on-chain transactions over time, starting right in January 2009. So you can see the number of on-chain transactions starts to pick up during that 2013 bull run, and it peaked pretty hard. I mean, a huge spike in December 2017.
It collapsed by like 90% almost.
Right, exactly.
80,
and that's it got almost to 500,000 transactions per day. And, right now we're sitting at around 300,000-ish transactions per day. And I want to say that, on average, you're getting between 300 and 400,000 transactions per day. So, if you're an institutional investor and you're objectively sitting and looking at this, you're saying, okay, well, clearly demand is growing, right? There's more transactions every day. That's good. The transaction fees, the transactions drive the transaction fees, which helps secure the network. So that's good. And, it's a permissionless amount of transactions. And, that 400,000 transactions per day is approximately 15% of Swift transactions, that's more than I thought, actually. I guess I didn't know what to think, how many Swift transactions there are per day, but this was actually more than I thought. So I don't know. Do you think this might play into the investment decision for someone who's taking a look at this presentation?
In terms of just this portion, the transactions?
Yeah.
Yes, I would say yes. The reason I say yes to this is because, as I've noted before in other podcasts, one, wire transfers are a bitch and they're expensive, and we've seen numerous times where, like, you see whale alerts, or you'll see those things where it shows, transferred, $1 million of Bitcoin for like what, $1 or something stupid cheap, which I know wire would be much more expensive. And then the international side, and then also just not being able to send money at any time when you want, you know. And then international wires are just a cluster fuck, pardon my language, but that's what they are. And you know, I don't believe you can do a same day international. I know in the U.S. you have same day wires, of course, but international it's what, like 3 days. Depends.
I want to say it's
3 to 5. It really depends.
3 business days. Yeah.
And then like with my experience with it, if one little thing is wrong, it's all over, and then you have to wait like a week and a half for them to recover your money. Like, how does your money go missing? It's fiat currency. Why can't they just fucking throw it back into your bank? Like,
yeah, it's fascinating how the legacy system, can really stumble with things like this. We're using a different monetary technology, and it seems so easy. And you're like, man, I can't believe you guys haven't figured this out yet. So, it is very frustrating to think about. Almost to wrap it up, the next slide's getting closer to the close here with Bitcoin adoption, and it's talking about the Lightning Network. I want to say it's on slide 27, so that's 3 slides down. Yeah, this one right here. Yeah, so again, I'm going to ask you this question. I want your take on it, but just to very quickly cover the Lightning Network, it's just another protocol built on top of Bitcoin to make everyday payments and transactions, cheap and fast, basically. So it's hopefully to scale the network. You'll be able to get to, hundreds and thousands and millions of transactions per second. You're not going to hit that peak of 500,000 transactions on chain per day that, is a current limitation of Bitcoin, and everybody has a good understanding of that. But I think they threw this slide in there just to talk about kind of the latest and greatest in terms of technology breakthroughs that that Bitcoin is using, because when you sit and look at on-chain Bitcoin, it's not that great of a money, right? It's slow. It's, it can be relatively expensive to use it, especially for what's the example everybody uses, buying a cup of coffee with Bitcoin. Like that's, not necessarily the best use case of Bitcoin, but, people like to do it because it's kind of, you're showing off. I'm using I'm using this other money, right? You're buying with sats and doing that stuff. But again, this kind of stuff takes time, just like you needed email protocols and HTTP and, all the different ways that we use the internet today. There's going to be different ways to use Bitcoin as a more functional money as it starts to scale up and gets layered on top of. But, one of the things they didn't mention in this presentation, and I can understand why they wouldn't mention it, and something that you and I constantly talk about, is the biggest way to increase Bitcoin adoption is what? Number go up, right?
Number go up.
Price ultimately drives adoption. Do you think they purposely left that out because that might be considered egregious from like an investor relations standpoint?
No, and you and I can talk about it because we're not handing out this. I'm like, hey, invest here, but there's no way around it. Bitcoin at 100K is going to grab a lot more eyeballs than Bitcoin at 9,900.
Right. It's just the way it is.
Yeah. And as we talk about, until we cross 20K again, I think a majority of the, newcomers we won't see. And who knows? They might not come in, assuming price keeps running, they might not come in until 30K, 40K. Who knows? I have zero clue. But people forget, it's a chip shot once Bitcoin goes from 20K, 20 to 25Ks. Oh, it's only, 25%. That's nothing. Bitcoin, we've seen Bitcoin move 25% a day,
Right.
And that's a $5,000 a day move,
Yeah, that starts to get really nuts.
Numbers start to get crazy. When you talk about Bitcoin at 50K, okay, so if it doubles from there, you're at 100K. And as we said before, we've seen Bitcoin move 30, 40% in a single daily candlestick. So, number goes up and it gets really, really scary is the term I use, because things get really wacky. Like we saw at the end of 2017, where people were calling the top every time we went up another $1,000. And like everyone's thinking, oh, 8K, we dumped from like 8K to like 5,500, and then it just fucking rocket ship.
Yeah, it can get very emotional, and that's the FOMO effect. It's been so long since I've felt the FOMO effect, and just that pure euphoria of not understanding how this thing keeps on running and running and running. And I'm glad that they left it out because it's not really relevant, but I think it's more logical and intuitive that, people won't care until new all-time highs are broken again. And I can think about all of even my personal friends who were interested in the space in 2017, who literally just have not mentioned it in 2.5 years. And I can guarantee they will not mention it again until new all-time highs are broken and it's not dead yet. And they don't think that they've like lost their money to a scam. And that's like the only way I can think about it. So that's my kind of final take on it, is that, price ultimately drives adoption, and all these presentations are fine and good. And I think the message is starting to get percolated out to the market and other people with money who are starting to reconsider Bitcoin as something that they want to get exposure to. But at the end of the day, the only thing that's going to really force people to kind of jump in with 2 feet is the price going back up above new all-time highs, and people can just finally say it's not dead yet. Is there anything else you kind of wanted to finish up on there?
All I know is that things are about to get wacky. I know that's not dealing with our, this topic of the podcast, but Bitcoin is a part of this whole macro realm. And as we've seen more and more, we see more, whether it's people like Dave Collin coming to accept Bitcoin, people like Raoul Pal coming around, people like Jesse Colombo. Jesse Colombo never talks about Bitcoin until probably the last 6 months.
Yeah, I mean, he's mentioned it historically, but he did mention it a few times, right?
Owning it. That's what I should have said. Owning it. He's mentioned before, obviously in the past, in terms of the crypto bubble. I'm sure I wasn't following Jesse Colombo in 2017, but I'm sure he was like, holy shit, what the hell's going on here? This market cap went from 10 billion to 800 billion. And so, or 17 billion if I want to be exact. But the point is that it's pretty ridiculous where we are right now, and we're going to see Bitcoin play out in this whole realm and see if it's truly a safe haven asset, which at this point I believe it is, because we still have Bitcoin at 9,900 or 10,000, whatever it's at right now, which 3 years ago people were like, holy cow, but not now because Bitcoin hit 20K. So
right, it's at 10,000 and nobody cares. So yeah, I think that's
a good sign.
The more boring, the better, I think. Yeah. I think that was a good way to wrap this one up. I'm glad we kept this one to a single topic because it was a good presentation to go over. I will make sure to put the link to this presentation in the show notes for you guys to take a look at. So,
and if you can, YouTube definitely prefer to watch if you want to see it. But obviously, if not, click on the show notes link. It's definitely worth going through. There's a lot of good graphs and little info charts in here.
Yep, they did a really good job. So, this was episode 74 of the Beef and Bitcoin podcast. Make sure to like and subscribe on YouTube. Leave us a review on Apple Podcasts. That really does help us move up in the rankings. Shoot us a DM. Let us know if there's any other topics you'd like us to cover. We do appreciate that. So, all right, stack sats out there. Be careful and peace.
Peace. And Bitcoin closed a weekly doji. Time for some indecision.
There we go. Get ready.